Yeah, good evening to all. I'm Nagendra and I'll be your moderator today. And on behalf of the entire NSA team and CPI, we welcome you all to our second knowledge series session on Brent Crude. Also, briefly talked about how the storage facilities are some of the key vital ingredients which influence the entire market dynamics. So, today, what we have done is as part of our second session, we have chosen the topic how low can the prices go. So this is taking into consideration what happened to WTI. So we thought, we have brought in three eminent personalities who will give you a complete overview of Brent crude based on their expertise in this field. The structure of the session is very simple. So first, we will have NSE's Chief of Business, Mr. Ravi Varanasi, who will give his opening remarks, and then I will hand it over to the other speakers. And any questions that you have to use the link which has been shared, and I will take the final responsibility to post the questions to each of the speakers. Thanks once again for joining, and may I request Mr. Ravi Varanasi to give his initial comments, please. Ravi, over to you.
Thanks, Nagendra. And good evening, friends. Mr. Vadhwa, Yamshekar, Kunal, thanks for joining us. CPA, I thank CPA for collaborating with us for this particular seminar. As Nagendra mentioned, this is our second in the series on crude. We're all obviously, the way we have met today is not normal. Hopefully, this will be the new normal as we go forward. We are living through a set of extraordinary times, and obviously there is tremendous amount of volatility in markets across all markets, not just crude. That's mainly because of the uncertainty which is associated with COVID. As things, we are almost every single nation across the globe is in some kind of lockdown. There are efforts to slowly bring the lockdown situation under control. There are debates which are going on in terms of how exactly the lockdown can be unwound and how exactly the economic activity could be restarted. India, the situation is much better compared to most other countries, particularly in terms of the infection and the death rate. In both cases, India has fared reasonably well. I'm not really saying this kind of scenario nobody can take a final view. But looking at the situation in most of the countries, I think we did reasonably well. The number of infections has been relatively low compared to the population and the size we have. And the death rate is significantly lower, almost half of world average. So possibly the reason for such a scenario is the lockdown, which was imposed very early stage in our infection scenario. So I think that has helped. But the overall economic activity has stalled, not only in India, across the globe. That has led to serious demand destruction across almost all other than essential services, everything else. We have seen a tremendous amount of demand destruction. That is having an impact, obviously, across the board again, not just in crude. Supply chains have kind of snapped. The people are trying to get their supply chains in place. Labor movement is going to have serious implications. A lot of people have moved out of the places where they work. So getting the people back into the factories is going to be a serious problem. As we start looking at gradual opening up, there's going to be a fair amount of difficulties which we're going to face. Obviously, medical solution is going to be the critical component for a complete normalcy to return. While there is efforts which are going on in finding a cure and a vaccine, we just can't keep the economic activity completely shut. So we have to get used to the new normal as we go forward. There will be continued volatility because of the uncertainty which is there and which will continue to be there for some more time. So we'll have to live with the uncertainty and the resultant volatility. That's why we have been talking about specific products, in this case crude. In India, Indian crude is essentially linked to Brent, and almost Brent, 2/3 of the world crude prices get linked to Brent. And so far in India, WTI on the derivatives markets, WTI has been the contract. But when we launched our commodities market, we have decided that we should look at Brent, which is far, I mean, it is linked to India. And if any of our people, our market players want to hedge, we thought Brent is the ideal contract to look at. That's where we have launched our contract. While we are still in the phase of building up the liquidity, there are a few challenges which are associated with building liquidity in India. But Brent is a very, very liquid contract on ICE and has been doing exceedingly well. I'm sure Gyan Shekhar, Kunal, and Mr. Wadhwa would talk about major differences between Brent and WTI, and why Brent is far more stable, and possibly why it may not go into negative territory, while WTI did go into negative territory. Theoretically, particularly any physically delivered contract will go into negative territory. But in this case, we believe Brent being is a cash settled product not only in India, even in ICE it is a cash settleable contract. So to that extent, the possibility of Brent going into negative is fairly remote. But having said that, we are building our capability to handle negative prices, both in futures as well as options. We are looking at mid-June as possible date for launching the negative capability to handle pricing. But the work is on. But our sense is, again, I'm sure experts will talk on this far more in detail. I don't want to really talk about that. We are very keen on building a Brent liquidity. And as I said, we are working closely with SEBI to try and bring in a market making program into Brent soon. We have already submitted our application quite some time back. We are working with SEBI. We are hoping that they will give approval for market making program in Brent. If that comes, we think Brent does give an opportunity for Indian market to handle their exposure to the crude far more efficiently. And we look forward to your support. Thank you very much for participating in this seminar. And I'm sure experts will take care of you from now onwards. Thanks a lot. Over to Nagendra.
Thanks, Ravi. So before I introduce the next speaker, I think I have to do justice by introducing the speaker, Mr. Narendra Wadhwa. So I will talk. I'll take a few minutes to give something which the market is not aware of, Mr. Wadhwaji. So everybody knows that he's currently the president of CPI. And what the market also needs to know is that he's also the chairman of National Council for Capital Markets and Investors Education with Ashochan. And he's also a member of various committees like your CDAC and RMRC, which are regulatory committees. So he's a chartered accountant by profession. He has also got a law degree, and he's also an alumni of Harvard Business School. And recently, he was awarded the Pride of India Golden Award by the President of Mauritius at an NRI summit in Mauritius, and also a Global Indian Award recently at one of the functions by Times Now Global in Dubai. So over to Mr. Narendra Wadhwaji of CPI.
Thank you, Nagendraji. Good evening, everyone. I'm Narendra Wadhwa, President of CPI. On behalf of CPI, I thank Mr. Ravi Varanasi and NSE team for associating with CPI for knowledge series on webinar. I compliment them for the initiative and welcome all the participants. In fact, as proactive and responsible members association, we welcome and compliment all initiative of exchange for products and contract innovation, safer ecosystem for the members and investor education, and skill development. As the nation goes through a period of staying at home, this is the best time to enhance ourselves and take a deeper look within and enhance our knowledge and sharpen the skills. We know famous Darwin theory, which says all our ancestors were monkeys. Another Darwin theory speaks about survival of the fittest. And another very important theory was that not the strongest and the biggest are winner, but most responsive to the change are the winner. So I compliment NSE again to sharpen members' knowledge. The world was amazed and shocked at the slide in oil prices and prices going down to zero, and seeing that members were paid to buy oil. As COVID pandemic took a toll of world's economy, with the supply gut, with limited storage space available, the US was running out of space to store the oil produced. And the buyers were desperate to store the oil inventory. Such was the need to sell the contract that on April 20th, WTI May futures contract traded 306% lower to settle at minus 37.663 a barrel. To deliberate this, we have today's webinar topic, how low can oil go? I briefly touch upon it. When it comes to crude oil, we all know that there are two grades. The most popular traded grades is Brent and West Texas Intermediate, which we call WTI. Brent is the benchmark price used by Europe and organized OPEC country, while WTI crude price are benchmark for US oil prices. As mentioned by Raviji, 2/3 of all oil traded globally and close to 90% of India's crude oil imports are benchmarked to Brent crude. Brent crude has a 90% correlation with Indian crude oil basket as compared to 88% of WTI. Brent is also linked to seaborne crude with fewer storage limitation than WTI, which is settled physically in a landlocked storage like Oklahoma. I feel NYMEX WTI crude are non-comparable contracts for Indian settlement reference rate because there is no option to give and take physical delivery. Without a doubt, Brent crude today is the right indicator of global and Indian oil. Hedgers, traders, and participants can correlate with the Brent crude. In order to ensure that commodity derivative contracts are closely aligned to a physical market, it is imperative to have a framework to evaluate the performance of these contracts. I would like to refer here SEBI circular issued in November 2019. SEBI came out with a circular wherein it asks exchanges to review commodity derivative contract performance on annual basis in their product advisory committees. The parameter for review includes background of commodities, its sample picture, various varieties, grades of commodities found and used in India in its life cycle. So whenever we discuss about the contract in commodities future, we need to consider purpose of commodities market, which primarily is price discovery, price risk management, and predictable pricing, besides other. So we have to see all contracts achieve this objective. So to conclude my remarks on today's topic, which is how far oil can go, there may be many reasons for that. The weakening global demand is one, and the other alternative sources of energy which have emerged over a period of time. I quote Warren Buffett here. He said in shareholders meeting last week, I quote, "I don't know, and perhaps with the bias, I don't believe anyone knows what the market is going to be tomorrow." I will again quote popular Murphy's Law, which says things will go wrong in any given situation if you give them a chance. Or we can say, whatever is going to go wrong will go wrong. As a CPI representative, I'll request you to join our upcoming webinars. Please take care of yourself and your loved one. I'm sure we'll get through this tough period together. Thank you.
Thank you, Mr. Wadhwaji. Your presence and your support has always been a pillar of strength for NSE. Before I invite the next speaker, Gyanasekar, based on whatever Mr. Ravi and Mr. Wadwaji had quoted, there is a fundamental difference between the WTI crude and the Brent crude. If we all go back to the settlement mechanism of how WTI settles at NYMEX, it is completely physical in delivery, and Gyanasekar can talk more on why it went into negative, though most of us are aware of the problems related to that. But if you talk about the Brent crude contract at ICE, so it is a cash settled contract. Though, see, they say that it is settled in exchange for physical mode with an option to settle in cash. When we say exchange for physical, what it means is two parties coming together bilaterally, wanting to settle their contract physically and then reporting it to the exchange. So it is something bilateral in nature, where if two parties want to settle the transaction in physical. So now I would invite the next speaker, Gyanasekar Tyagarajan. So Gyana is a well-known personality. He has got over 20 years of experience in commodity and FX markets. So he started his career as a forex and a bullion dealer with one of the leading banks, Nova Scotia. And prior to that, he was also doing technical analysis for the Wall Street Journal. Today, as we speak, he's currently working with a lot of corporates who are in the energy segment, and he helps them in managing their price risk to overcome the current volatility. Over to Gyanasekar.
Thank you, Nagendra. Thank you, Ravi. I hope I'm audible enough.
Yes, you're audible. Can you show your presentation?
Okay, wonderful. I'm just going to take off from where Ravi had left on the way things are at this point in time. There are a lot of negatives, but market has this beautiful way of discounting most of the negatives and looking forward ahead. So I guess that's where we are at this point in time, which is why we've seen that the oil prices have not fallen more than what has already happened. So I guess it's kind of discounted most of the negatives. So with that background, that to me it looks like most of the negatives have been priced in. I'll move into my today's presentation. Basically, what we have done today in this presentation is that I've taken the fundamental part of it and the technical part of it. I'm not going to spend too much time on most of it, but basically the highlights of these fundamentals and technicals is what we're going to discuss today. The most important one being the EIA, which is the Energy International Association. I think they have come up with some really sharp reductions in global numbers. And they feel that this current situation will continue to persist for some time. That's because they're the think tank which guides the market, the energy markets overall. So they're of the opinion that this could continue for a while, and it will persist through the second quarter too. But on the other side, reflecting hopes that the oil industry may have passed the worst. Hedge funds, who are typically the big players and money managers, have started buying derivative contracts. They've been short heavily, which is the reason why we saw such a huge fall. And one of the main reasons, I'm sure people would have read a lot about why prices fell, but in a nutshell, it's basically because somebody wanted to roll over the position, and they found that there were hardly any sellers. And the way the mechanism works in most of the derivative markets is that you keep overnight orders, and when there are hardly any orders, then it starts moving to the next best possible bid. And finally, the best possible bid was around minus 39. So from there, things have changed. So if you look at the overall hopes, I think hedge funds and money managers have started looking forward to a positive market ahead on the fundamental side. But having said that, we should not forget the fact that we are historically, lowest period when it comes to demand. Until air traffic is resumed, I don't think this weakness is going anywhere at this point in time. Also, we need to talk about the crude oil stockpiles which are rising in the US, where the inventories of the products are continuing. I mean, I think it's likely to only rise because of the current lockdown. But the positive thing in the EIA assessment is that they're looking at the record inventory builds that are presently seen, turning into record inventory draws going into the second and third quarter. I mean, going into the third and fourth quarter, which I think, in my own personal opinion, that's a very good development because the present situation, people are focusing too much on negatives and not looking at what is ahead. So I would take away this as one of the most important things which EIA feels that we'll get into a possible inventory draw compared to a huge inventory build which is overflowing at this point in time. I'll come to the Brent and crude. I just want to highlight the most important differences between the Brent contract and the WTI contract. And I'll come to it once I'm done with the outlook. This is what I'm showing you just now is the chart of WTI, where on one day it hit 39, then it recovered from there. In the chartist jargon, something which has gone negative, statistically the whole picture changes. You cannot rely on moving averages anymore. You cannot rely on so many other statistical indicators after it's gone below $0. So, as a chartist, if I look at the crude oil chart again, I'll never trust what's going on there because it is move below $30. I mean, move below $0. So, having said that, the view is that we feel that in the months to come, we will see a possible move up to $37, $40, probably on the back of opening up of economies slowly. That will lead to some demand increase, and because of that, we will see some bullishness. But whether it will sustain there is a huge question because the economic impact of this demand destruction we're seeing, the actual numbers will start coming going forward. So when they start hitting the market, I guess we will see more weakness subsequently. So on the WTF front, our conclusion is that we are going to see a recovery now, but that recovery will sort of be short-lived, and there are some massive resistances and people waiting to sell WTI, and therefore better to avoid it. And with this kind of a scenario, what we have gone through, market also has lost its confidence. So I'm not sure how much the participation will be compared to what it was before once the market reopens fully. So that's about WTI. So now moving to Brent, because that's the key part of my presentation. On the technical side, luckily we've seen stability. It's never gone below $18. That was the lowest we saw when WTI hit minus 35. And the charts are pretty secure. We don't have to worry about the charts. Most of them are statistically stable and showing excellent indications going forward. At this point in time, I think Brent is just building itself. And as the economies open up, we might see a move up from here to around $40 and maybe even push to around $43, $45. Gradually, I think that's what we're expecting in Brent. So there is an important gap. In technicals, we call it a gap. That gap is anywhere between $45 to $50. So that's a key area one will be looking out for going forward in the coming months. So at this point in time, if Brent were to dip due to any reason, I think that would be a wonderful buying opportunity to position oneself for this gap of $45, $49 side. So that will be a wonderful opportunity as far as Brent is concerned. So fundamentally, Brent has rallied and more stable actually. Even though we've seen a very nice move to the upside, the reality is that we are still in a bearish market. We should not forget that. Though my own personal expectations is that markets will start gradually picking up from here and start testing resistances. But we should not forget the underlying trend, which is still bearish. I don't think we have gotten out of that. For that, we need to close above certain key levels, which is what I was talking about earlier, is somewhere around $45, $49. So once we close above that, I think there will be a lot of buying which will return. And based on that, our own predictions is that the second quarter, which is June, which is April, May, June, we'll be looking at anything closer to $35 or thereabouts as on the lower side, $30 to $35. If it holds there well, there's a good likelihood that subsequently it will start going up. The third quarter, we expect, as I said, the economic number and impact of all the demand destruction could pressurize it a little bit. We could see some bit of a correction back to around $20, $25. And from there, I'm expecting a very sharp rally higher to around $45 or something. So to put it in a nutshell, there is downside. We should not think that we are out of the woods. There is a possibility of some volatile moves which can happen, but that will be limited and a wonderful opportunity to start positioning oneself on the long side. But I'll go back to the Brent and WTI contract. This is very important because people need to know basically what is the difference between the two. We all should understand that US was a large consumer. They turned to a producer only recently after the shale oil boom. So they were never prepared for storage in a big way. So they just took it as it came. Whereas Brent, on the other hand, most of the storage is seaborne. Most of the cargoes change hand while at sea itself. So Brent storage mechanism has been time tested and proven. It never come like a shock like what we saw in WTI. So that's a very robust storage mechanism. In fact, there was a rumor that when the Iran problem was going on, there was a war going on, that they might have an alternative way to shift the oil from Middle East into countries like India and store it. I don't know where that is right now, but just to highlight the fact that Brent has an amazing storage mechanism compared to WTI, which will not fail much. And Brent has a body like OPEC to support it, unlike WTI, where it's just US based and it's a shale industry, which again goes through ups and downs based on the price. So you have an organization backing it well. And if you look at the margins also, recently because of all these developments, the domestic exchange margins have been hiked a lot. So that will discourage investors from participating. But on the other hand, the NSE Brent contract, whenever it is becoming active, is a very nominal margin compared to. That's a great positive as far as investors are concerned. This is a commodity which we've been, as a country, importing. So the focus, I think, will come back into Brent. And I think NSE has done a wonderful job to identify Brent as a contract to really look forward to. My best wishes for them to, get this active and moving at the earliest. So with that, I'll end that. Thank you.
Thanks, Gyana. So let me introduce the next speaker, Mr. Kunal Shah. Kunal Shah is currently the head of commodity research at Nirmal Bang Commodities Private Limited. So earlier he was heading the research at Motilal Oswal Commodities. And Kunal has got close to 16 years of experience in the Indian commodities market. And he's a specialist in tracking metals, base metals, energy, and agri commodities. So in his current profile at Nirmal Bang, Kunal is responsible for guiding the commodity research vertical, and he manages a team of professionals who not only cater to retail clients, but also to corporates seeking hedging solutions. So Kunal is a regular speaker at various international events and conferences and appears regularly as a commodities expert on various business channels. He is most sought by the print media and wire services on regular services for his views and comments on the commodities market. Kunal, all over to you, Kunal.
Yeah, thank you very much for the introduction, and again thanking NSE for inviting me for this webinar. I'll try to do the justice. So before I begin my presentation, I would like to brief on why Brent, what is the relevance of Brent, and what strategic importance it is having. So first of all, when WTI crashed to a negative territory and Brent did not, one must understand why Brent cannot technically go into negative. So apart from the points Ravi sir made, the most important point is that this is the benchmark in last 15 years whose production has declined. So I remember in 2006-7, the Brent basically refers to the Red Sea oil production, and there are four benchmark BFOE. So Brent, Fortis, EcoBurs, and Osberg. So these are the four benchmarks that combines and makes it a Brent. So the combined production at that time was 3.5 million barrels. Right now, it is not even 1.5 million barrels. So it is not even 2% of the global supply. So what is basically done by the OPEC is they know production of Brent is continuously going down. So they have basically benchmark all their oil with the Brent. So if you ask technically, Brent cannot go to the levels that the way WTI went, because the production of Brent is continuously going down. But on other hand, the WTI production in last 5 years have risen from nowhere, from 7.5, 8 million barrels to 13 million barrels. So that market was heavily oversupplied, and Brent over last 15 years, production is not moving up and it is continuously going down. So now for entire Asia, OPEC so whenever Iran or any other country quotes to our country regarding when you go to buy oil, it is Brent plus. So Brent plus or minus. So if the markets are bad, they'll give us discount. But if markets are doing well, we have a Brent plus. So the benchmark itself is Brent. So the strategic importance of Brent is very much there for all the Indian hedgers also. And like the Ravi sir said, it is not a deliverable contract; it is cash settled contract. That also adds to the bargain. So the fundamentals of the Brent is not bearish at all. Forget the broader oil market fundamentals may be bearish, but Brent as a benchmark, it's not bearish. So on that note, I will start my presentation. What is basically the macro theme and where the oil prices are heading, because we also have to consider the macro theme. So right now, the way this COVID-19 crisis has hit the world, so we've never seen in the history of finance in 1920s. After that, we've not seen this kind of lockdown. So what happens to all the supply? Forget about just the oil, overall supply chain. The entire supply chain is disrupted. So people are talking about recession will come, but the threat right now is not just recession. So if this second round of COVID-19 crisis starts again, then what is going to be the outlook? So right now, the fear amongst everyone is not recessionary, it's a deflationary fear, which is haunting everyone. In environment, the fundamentals of oil doesn't improve. So I would stick out my neck and say $45 for Brent crude oil is as good as $100, what we used to see earlier. So when you see if Brent prices are again rising to levels of $40, $45, it is as good as, we are seeing the $100 Brent prices in 2007. So if you look what has happened, most of the economies, Canada, Germany, France, UK, Italy, and US, this shutdown has led to overall downside in growth by 15 to 20% in majority of this sector, may it be transportation, hotel, construction, real estate, retail, and other sector. So this is very deep. This is not some nominal losses. The losses what we are talking about is pretty humongous. So if you look at the second slide, the cumulative output loss is over and about $9 trillion over next 2 years. This is humongous amount of loss, and this is very important in context of the oil demand. So if the economies are not going to do well, how the oil demand is going to pick up to the pre-crisis level? It is practically impossible that we are going to see that kind of demand again coming back to the market. So People are expecting that in some time this will be solved and again we'll be back to normal. But I think the normalcy will take a lot of time, and I really keep my fingers crossed that it doesn't the COVID crisis doesn't restarts again, and it doesn't have to go for the lockdown going forward. So these are my points. So after the IMF, the Federal Reserve started to came up with a humongous amount of stimulus. So the Federal Reserve's balance sheet expanded from $3.7 trillion to $3.6 trillion in a matter of 1.5 months. So this kind of monetary printing also we have not seen in the history of financial market. So all the asset prices have started to move up because of this humongous monetary stimulus launched by the Federal Reserve. So along with the other asset class, oil prices also recovered because so much money has been pumped in the system. And this money is flowing in the veins of the financial markets. And that is also one of the reasons why oil prices recover. So now let's go into the fundamentals where everyone will be interested in. So before the crisis, so at the end of 2009, on December 2009, the oil market was in a surplus of 0.5 million barrels. So from 100 million barrel market, the overall surplus was 0.5 million barrels. And then there was a lockdown in China, especially in Wuhan. And then it started from the month of March, in major economies started to adopt the lockdown. So by the end of the first quarter, this surplus widened from 0.5 to 7.7 million barrels per day. So I don't remember in last 10 years, I have not seen this number, that 7 million barrel surplus. And this is still March. Okay, forget about April, what's happening after April and May. But what happened dramatically, that in this period, OPEC decided to increase their production, mainly led by Saudi Arabia. Saudi Arabia said that their production will increase from 10 million barrels to 12 million barrels in the same period, from the month of April. So this led to a major problem going forward. And then all of a sudden, one after another, from the month of March, and all major economies started to initiate a lockdown. So if you look at the overall chart here, the world demand, which was 100 million barrels at the start of 2019, has fallen by 20 million barrels. These numbers are very conservative. The other estimate says that it is 25%. So I've taken the conservative number and I'm saying that 20% drop in oil demand. Okay, so that number comes to 80 million barrels. And before this production cut started, the overall supply stood at 102 million barrels. So when oil prices went into negative, at that time, we were having a surplus of 22 million barrels per day. And the storages were getting full. So there is a principle in the commodity. Whenever there is a shortage, you cannot quantify how much oil prices or any other commodity prices will go up. Shortage doesn't have a price in commodity. So it goes into any level. So same way, when there is a glut, it is very difficult to quantify how low it can go. Because this glut is not, so generally if you look at the 5 years average, the 5 years average is 0.6 million barrel of surplus, and suddenly there is a 22 million barrel of surplus. So how the markets are going to digest this kind of number? So OPEC announced that from the month of May, there will be a production cut of 9.7 million barrels. And with the oil going below $0, we saw that US companies were started to get bankrupt, and US oil production, we are expecting in next 2 months, will conservatively go down by 1.5 to 2 million barrels. So cumulatively, out of this 22, now 12 million barrels of production cut has already taken place. So OPEC 10 million barrels, and US, I'm assuming 1.5 to 2 million barrels. So this number now, this surplus is narrowed down to 12 million barrels. Now, once the economy, so Germany is planning to start the economy, a lot of European nations are going to start the economy. US is also planning to lift up the lockdown in a lot of places. So after they do that, we are expecting the oil demand will recover conservatively by 5 million barrels per day. So if you take a 12 million barrels of surplus, and if you deduct 5 million barrels, then the overall surplus will be somewhere near to 7 million barrels. So this makes me believe that we are out of the woods for the time being. And if there is no second round of lockdown coming, and if the coronavirus crisis is contained and is not again spreading, then I think the oil crisis, what we've seen is, you can say the worst is over. So what happened and why the prices went negative? There was no space to store oil. On the eve before 20th April, from last 6 days, there was news going on in Bloomberg that Canada is selling oil in negative -$2. So everyone was ignoring that news, that -$2. Why? Because Canada was not having oil. Where they are going to throw that oil? Canada is producing roughly 4.5 million barrels of oil per day. And where they are going to throw all this oil? So that's why they were selling it in a negative. And after that, we saw prices collapse. So the main gray area for oil surplus is mainly US and Canada. So the production in last 3-4 years have increased dramatically, especially in US and to a certain extent in Canada. So that's why we saw this kind of black swan event in oil. I cannot imagine that any commodity prices can go into negative. But like I explained, anything can happen in such kind of market where there is no. So it's a technical problem. If I'm having oil, so if you look at this chart, before this Cushing, Oklahoma, which is the NYMEX delivery point. So if this inventory was just getting filled up by 15 million barrels on 20th of April, there will be practically no space to save crude oil. So there was no storage capacity available on NYMEX. So that's the reason why we saw what happened in crude oil. So now, what is the road ahead? Where oil prices are heading? So now, like I said, with the lockdown going to get relaxed, we are going to see a gradual recovery, and this oil inventory, the red line, what we are seeing, is likely to come down going forward. So I'm expecting with the declines, oil should be bought, but I'm not expecting any structural bull run because for next 3 months, OPEC is going to cut 9.7 million barrels from the market. If the demand recovers, slowly and gradually, they will restore back the production also. So not very bullish, but I'm expecting recovery. So for the Brent crude oil prices, my conservative target should be $30 to $35. $35 is my conservative target. And any decline to the tune of $25, $24 should be used as a good buying opportunity, provided there is no further COVID crisis. So that's all from my side regarding the outlook. And my personal recommendation is India has been waiting for the Brent contract. As an Indian hedger will love to hedge their risk if they are getting it on the domestic bourses. So it is a wonderful initiative by NSE. And we wish NSE all the best from our end and from the entire Nirmal Bang team. And I think this contract should really get a lot of traction going forward as far as the Indian commodity market.
Thanks, Kunal. So, see, we have got a couple of questions. There is one question which is common to all the three speakers. So, what I will do is I will post the questions in sequence of how the speakers are presented. So, I will start from the reverse order. Kunal, the first few questions are for you. So, see, the first question is that, do you think it was possible for someone to foresee the negative pricing?
No, it was very difficult. We understood that the glut is much heavier than what it is, what it actually showed. But it was not something, you cannot, I could not expect that oil prices will go down and test levels of -30. So it's a double black swan event, not a black swan event. It's a black swan event. So I don't think so. Nobody expected, honestly speaking. But there was an indication, even before the eve of what happened, Canada was quoting and selling oil for continuously -$2 for last 3 days. So I just could have corrected sharply. That was the indication, but not negative.
Okay. So the next question is, it says, again, from one of your investors, it says Nirmal Bang. He says, what are the measures that your team is taking to change the mindset of investors to shift, if at all it is required, it says, from WTI to Brent, post the WTI story?
So what has happened is that there has been discussion amongst the client, and all the brokers are concerned about the way the oil prices have crashed. So it definitely everyone is talking and everyone is thinking about the potential risk which we are having overnight. So because of that, if we are having another benchmark like Brent, so it will be much better for trader or investor to even trade in this kind of this contract, because the fact remains is the Brent contract is very much concerned with the Indian oil basket. So, and like I explained, the Brent oil production has been continuously going down. Whereas, so if you look at the chart of Brent, it is from 3.5 to 1.5 over last 2 years, and WTI from 7 million to 13 million barrels. So structurally, the day oil prices went into negative, at that same day, Brent prices were trading at $23. So there was a huge spread of $23. So even if you are, spread trader, this kind of opportunity, generally there is a big community in the international market which buys and sell Brent, and they do the spread trading between Brent and WTI as per the fundamental. So it was a huge opportunity for even that kind of community. So having a Brent oil in our trading basket in itself is a very big boon for the traders. And the likelihood of Brent going to negative, like I explained, is very, very less. So after looking at what happened to WTI, I cannot say it cannot, but that happening to Brent is very less. So we would definitely recommend our clients to even participate in the Brent crude oil contract, and I think a lot of clients should trade on the Brent crude going forward.
Okay, see, you mentioned about the spread, WTI and Brent spread, right? So there was a question pertaining to the correlation. So somebody is asking, if we have looked at the correlation and traded, do you think we would have made money, or do you think we would have burnt our fingers?
Yeah,
I think, I will let Kunal and Gyanasekar also answer. But Gyana, I will come to you. Let Kunal answer this first. Maybe you can have your responses ready for this question as well.
Yeah. So if you would have gone long in Brent and shorted the WTI, you would have made the fortunes. Okay. But what generally happens is that the spread trader also doesn't see this kind of spread. This is pretty abnormal. I mean, you cannot see a spread $25 to $30 negatives. Pricing $25 to $30 WTI going down to this extent. So if you are sitting on the right side, obviously you are going to enjoy it. But I have my own doubts. The way the deviation took place, even spread traders were out of the market.
Okay. So, see, this is one common question for all the three speakers, which I said. So, based on your seat, they have not posted as to whom it should be asked. So, I'm taking the liberty to post it to all three of you. So, you can answer this first. Based on your experience, so is your advice to market participants that they should start looking at Brent and stop trading in WTI? It's a tough question. I mean, you can pause if you want, but we will take your views as personal. I mean, if you don't want Nirmal Bang tag to come in, right? So since it's a question that has been asked, I leave that to you.
I would not say that I would not recommend my client to trade in WTI. I leave it on the client's discretion, but they know that when they are trading at the WTI, the kind of risk which is involved in. So in case of Brent, now they are very clear. Everyone is very clear that even in the worst time, Brent prices doesn't crash the way WTI does. So what is basically the client itself, they themselves want another benchmark to trade on. So it's been a voice from years, that the Brent crude should be there in the Indian trading platform. So with the introduction of Brent in Indian trading facilities, I think a lot of people naturally will start trading into Brent, considering the fact they know, rather than expert explaining them, they know that Brent did not crash the way WTI did. So if you are risk averse, obviously you are going to start looking at Brent more than the WTI. But the people who are trading in that WTI, who are habituated, they will continue to do that. They will forget after some time. But I think Brent crude oil contract will get a lot of traction going forward in Indian commodity market.
Okay, perfect. So that's all I have for you, Kunal, as questions. Now moving to Gyanasekar. Gyanasekar, maybe you can start responding to those two questions, one on the spread and one on the advice to market participants. I have other questions also, which I'll ask you later.
Yeah. So I'll first take off from what there's another question which came about whether anyone anticipated negative price. So I'll quickly dwell on that for a minute. People realize that somewhere in the mid of March or thereabouts, I read a column on Bloomberg saying that NYMEX was preparing itself for a negative price, which means that NYMEX had the know of the positions which were lined up, and they anticipated that something of this nature could happen, which is why they made changes to the software. Because typically any commodity has an intrinsic value; it cannot go below zero. So they did the software changes because they anticipated. But the problem is not many took cues from that, or rather hoping that something would never happen of that nature. Yes, I think NYMEX was one of the first to anticipate this because they had the positions of most of their on both the buying and the selling side. So they kind of could see something like this could happen. Now, coming to the Brent WTI spread, Brent and WTI have been in this situation for a very, very long time. It's not just now. It's been there for years together. Brent has been in a premium compared to WTI for almost 6 to 7 years now. As soon as the shale boom started, WTI went into a discount. Only the discount has narrowed and increased over a period of time, but it has always been in a discount. So I don't think anyone would have been able to take any bet based on this or it's a fluke event. It's a black swan event, like Kunal said. So I don't think anyone would have been able to take advantage. Now, as far as the recommendation for a product of this nature, is clearly Brent all the way, because I also made a slide which highlighted the advantages of Brent over WTI. With also investors losing huge amount of money in this whole process, I think many would be discouraged to even look at WTI-based contracts here. And the more stable benchmark like Brent, with its fundamentals, with the way the whole body works in which the whole Brent contract is sitting on, I'm sure a lot of confidence will return. People will move from trading in WTI to Brent, but it might not happen overnight because the WTI-based contract here in MCX is quite an active one, quite a liquid one for a long time. I don't think that's going to happen overnight, but I'm sure a lot of people are looking forward to it. Not only me, I think there's a lot of investors, a lot of traders, and with the stability that Brent can offer, or something of this nature, is quite an impossible thing in Brent. I can't say impossible because there could be so many possible things that can happen, like an asteroid hitting the Earth. Then yes, something like this is possible. But under normal circumstances, I think Brent is a contract to really look at compared to WTI. I only wish said earlier in NSE the contract was already active, but I'm sure they're going to do their bit in getting it moving at the earliest.
So another question for you, Gyana. So will you be in a position to give a price level for Brent, short, medium, and long term? And another question which I'm linking to this is, where can people track your views? Have you started writing or posting your views online, or do you have a blog? Or they're saying, are you associated with NSE? So, which maybe, we will respond. But if you can give where people can track your views, if you're posting it somewhere, I think, that will be helpful on Brent.
On Brent, I'm not, but Brent exchange traded segment, my views are available on moneycontrol.com. So if anyone were to go to moneycontrol.com, they can look at my subscription-based views. But from time to time, my views keep coming on the print media on the visual media. So that keeps coming from time. You can check out in Google. Google, I think you'll see all my latest videos and columns.
Okay. So any price levels? I mean, so that you left that delivery. I know you are a cricket player, so you left the ball.
Like I mentioned in the presentation, I think the $45 to $50 is a very good likelihood. I'm betting on 50. Before that, dip to around $20-$25 is also likely. So the range would be anywhere between $25 to $50. So you must see a $25 kind of overall upside in the next couple of quarters.
Oh, that's lovely. Okay, thanks, Jnana. So now coming to Mr. Narendra ji. Narendra ji, we have a lot of strategic level questions for you. So the first question is, how do you think CPI will work with NSE to build this market? When I say this market, I'm assuming it is the Brent crude market. So what do you think CPI should do, or I'll rephrase it, or what do you think NSE should do, or how should NSE associate itself with CPI to build this market?
Nagendra, there is no doubt that today is the right indicator of global and Indian oil imports. Hedgers and traders and participants will benefit if they have globally aligned prices and trading practices in Brent crude. I think we are going to have more such programs to educate them for their participation for members and other participants. And as we have planned more such webinar going forward, CPI is with NSE for success of their contracts, and let's hope for the best.
Oh, thank you, Mr. Vadwaji. Another question is that we want CPI to do similar events in other products also. So I could have just avoided this, but I know it is going to be a firm yes from your side. But still, if you can say it in few words, how do we go about organizing similar programs in other products?
Yeah, definitely. We are also looking forward with associating with NSE. We know the leadership of NSE in equity product. We want NSE to take that position in going forward in the future. So we'll associate with NSE and we'll plan, I'll speak with you and plan webinar for other.
Yes, sir. So there is one question which has come. So maybe I will leave it to Kunal or Yanaseka to take it. The impact of crude pricing on Indian equity market.
If you look what we saw and what we are going to see, or the relatively to, if you look at the 5 years average of Brent crude oil, which hovers around $55 to $60, and now if you ask me for the next 2 years, the Brent crude oil prices are definitely going to be somewhere between $35 to $40, not above that, because this even $35 to $40 is with the production cut of 10 million barrel, which is not going to continue, because OPEC cannot afford to lose on the volume growth. So we are going to live with the lower oil prices, which is very good news for India. Right now, what we are seeing with the every dollar of oil prices, so the average of $50, $55, and now average of $35. So for next 2 years, India is going to save $20 as compared to what they used to spend on the oil. So it's a very good news, and right now that money is going to be used by the Indian government by raising the duties to the infrastructure project and the development of the economy. So I think it's a boon for India as a country.
Last question to
I agree with that, Nagendra. In fact, what you should understand is that a $10 move in Brent up or down, typically influences a CAD, which is the current account deficit, by half a basis point. So that's the kind of impact it has. And if I remember right, the last budget, when the finance minister had presented, I think they took 55 or 60 thereabouts as a benchmark rate. And now it is around 30, 35, so like literally 100% lower. So all this is going to certainly benefit India as an economy. But of course, these are long-term benefits. The short-term benefits are yet to be seen. I think it's I think the Indian economy will go through, and it's an amazing thing that's happening for us.
Thanks, Yana. Yana, one last question to you. So the WTI Brent spread is a good indication to predict the price levels, the direction of the pricing. Are there any other indicators which people who are not used to trade Brent to start looking at if they have to start trading in Brent? What are the indicators and where can they get an access to all these indicators?
Yeah, wonderful question, Nagendra. Wonderful question. One of the easiest indicators which investors can access is a report called COT report, Commitment of Traders report. Okay, this Commitment of Traders report typically gives out most of the information on how the industry is at this point in time, how the funds are at any point in time. See, typically in any contract, you will see hedgers on one side and the speculators on the other side. So how both of them are positioned is a great indicator of what's going to happen going forward. In fact, we use it very effectively to also forecast prices. But this is one of the simplest things I think one can look at. And ICE also comes up with similar data on Brent from time to time. So, but you have so many other complicated reports, but I think this is the most simplest and best one can look at.
Okay, before we close, there is one question for NSE, and maybe Ravi. The question is that any asset can't be below zero value. What better provisioning can NSE offer in contract specs that will give comfort to retailers who lost faith in WTI contract on the competing bourses?
Well, market forces have to, as our experts have spoken so far, the possibility of Brent going below zero is exceedingly remote. But if it does go there, the base to handle, one possibility is building the capacity to handle the negative prices, which, as I mentioned, we are working towards so that negative prices can be handled. The other way, which one of the exchanges has already announced, there's a floor for the price. That's a way of looking at it, but that's a temporary solution. But having gone through the entire discussion, the possibility of Brent going down below zero is pretty remote, and investors should not really worry about it.
Okay, now that we have almost responded to all the questions, so we are coming to the end of the session. I will take this opportunity to thank all the participants who have attended this session. And special thanks to Narendraji, Janasekarji, and Kunal. And a special mention for Mr. Sabarwal of CPI, without whom we wouldn't have been possible to get this session organized at a very short notice. Thank you, Sabarwalji. And see, we are all going through some tough times. And as Ravi was mentioning that, nothing lasts for long and that recovery is just around the corner. We sincerely at NSE urge and request each one of you to stay safe, follow the norms prescribed by the government, install the Arogya Setu app, and support the government in its initiatives in curtailing the spread of the virus. Thanks once again to each and every one of you for joining on this session. Thank you. Enjoy your evening. We are closing this session formally. Thank you.